Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
In any case, it's 7:05. Let's go ahead and get started. So without further ado, guys, Jim Whitesides is on. Tonight is we're going to talk about how you can help your clients sell their home and direct the gains into a qualified opportunity zone investment. There's a lot more to that. There's a lot to unravel here. But if you guys wouldn't mind, give Jim a big round of applause, a pat on the back, or if you want to do a thumbs up or a hand raise on the chat, that's fine too. And Jim, feel free to take her away. Your co-host, you should be able to share anything you have. And and Tom and I will man the chat box for you. You can also look at the chat box yourself if you'd like.
Okay. All right. And sharing my screen is probably what I'd like to do. So
Okay.
we'll start with that.
By the way, while Jim's doing that, you'll see George McIntosh is on, and he's a colleague from Down Under, and he'll be teaching also with Debbie DiMaggio in October. And I won't spoil the surprise. You'll have to wait for that. But we're great to have George on tonight. George, you're welcome to ask questions, chime in anything you want. Just this is open forum, so we like people to ask questions and engage.
Well, Gary, there was one thing I did want to ask. I noticed you promote people very quickly, and I've been looking for promotion for a long time, so maybe you can upgrade me.
There you go. You're in. You're hired. So yep. Okay. All right, Jim. Looks like we've got that up, and you can keep that view if you want. Let me get rid of the tinny panel. That open up a little bit more. You do the speaker view to make it bigger, but actually this is probably good the way it is. I like to do this view myself because I can see what slides coming up next.
Right, right. I kind of like that as well. So if you don't mind, I'll go with
Yeah.
that. So yeah, hi everyone. I'm glad to have a chance to speak with you tonight, and thank you, Gary, for having me on. So really, I will get right to it. I've got what I think is a very unique idea that's intended to help you win more listings, plain and simple. And here it is. Um, Oftentimes, home sellers will worry about a number of different things, but capital gains taxes can be one of them. And so, what we can show tonight is there's a great way to defer or eliminate any of the capital gains tax associated with selling a home. In addition, you can make future gains tax-free by reinvesting the proceeds of your sale into qualified opportunity zones, or OZs for short. Um, Opportunity zones are they're a type of investment that is typically associated with commercial real estate, but unfairly so. It is equally applicable for residential real estate, and as I'll point out a couple times here, it's a great way of deferring capital gains taxes on stocks, Bitcoin, really, literally just about anything. And so, but what's unique about this, I believe, is that nobody that I've heard of is talking to clients or talking in the marketplace about applying um, qualified opportunity zones, or OZs for short, to residential transactions. And I think that that's an interesting thing to consider. So that's what we're going to talk about tonight. I can't make taxes fun, but we can make them smaller, and that's almost as good, right? So I'll show you about how OZs work. For those of you who don't know me, as Gary said, I joined the team just recently in the last couple of months. So obviously I'm with EXP, but I'm also a registered rep with Great Point Capital, which is a broker dealer. And so what that means is I have one foot in both worlds, but I like to think that I can bring some ideas from the securitized side of real estate to bear for you, for your clients. I know a lot of you do have commercial clients, but in this case, this is an opportunity. It's an idea that comes from the commercial side, but I think it'll be very interesting. I think you'll like it. It's intended to give you something fresh to talk about, whether you know the homeowner or don't. But it's something fresh to talk about and something that your competitors almost certainly are not talking about. And I will also just add, you see Soundtrack Advisors is my logo there. That's just my brand for the team that I have. So that includes anything that I do on the security side of things or, on the physical real estate side as well. And the last item there you see at the bottom, I always have to have the compliance piece there. This is not tax or legal advice, and we always loop in, the client's CPA or legal team with any decision they want to make. So on to slide 2. Um, Home values, no secret, home values are up, which is great. Homeowners love to see that until they see the tax bill that goes along with selling their house. And for quite a few homeowners these days, the sales price is such that the tax bill will easily blow past the 250,000 or 500,000 exclusion for single or married couples, right? So what that can do is it can freeze some people keep them from listing their home. And even if they really are interested in selling, sometimes that can be a real problem. So if we can show them a path, the idea is if we can show them a path to avoid the tax and reinvest the gains on their home in a tax efficient way, then the idea is hopefully we can unlock more listings for you. So what's shown here, some of the typical reasons to sell, of course, retirement, perhaps poor health, downsizing, cash for next chapter, or whatever comes next can collide with, I don't want to pay that tax. And that can be a problem. So, but really, I think the problem is our opportunity to educate and hopefully save the deal. So by taking advantage of opportunity zones, again, OZs, your client can create some liquidity because the cost basis for their home can be returned to them after a sale without triggering a taxable event, which is nice. So if they have bills to pay and that sort of thing, the basis comes back to them, and they can defer any taxes on the gains by putting the gains associated with the sale, into an OZ. And I mentioned it once before, I'll mention it again. OZs can be used to defer gains on any kind of asset. So particularly with Bitcoin having done what it's done in terms of appreciation and stock market appreciation and so forth, if you or someone would like to redeploy those assets into another direction but wouldn't really want to pay the taxes, this is a great way to do it. So, slide 3. Opportunity zones, what are they? They're federally designated areas. They're all around the country where the IRS has created a tax incentive that's intended to attract long-term private capital for investment purposes. Oftentimes it's real estate. Sometimes other things qualify as well, such as oil and gas, and there are other sorts of opportunity zone funds. But that's basically what an opportunity zone is. So the way it works is your client takes any eligible capital gains and invests them in a qualified opportunity zone fund within 180 days of making their sale. And that brings about 3 potential wins. The first win, of course, is any taxes on the gains of the home are deferred. And again, the basis can come back to the client. The gains go into the opportunity zone. So the gain on the home is deferred. It's possible to generate then from that opportunity zone investment to generate tax-free income during the life of the opportunity zone. And then third, if that investment is held for the full 10-year period, any appreciation on the investment over the 10-year period is also tax-free. So
Wow.
it's a very powerful combination, deferring the taxes on the home, generating tax-free income, and then the asset that generates that tax-free income is not taxable as well. So that's something, again, that I would, I'm just sure as I'm sitting here that no one else is talking to um, their clients and their prospective clients about with regard to their homes. Let's see. I think we're going to. Do we want to do questions as we go, Gary? Do you want to hold them to the end?
Yeah,
What's your,
that's kind of a subject we probably should. So guys, if you have questions, go ahead and just unmute yourself or type them in the chat box. I know when Jim and I were first discussing this, um, I needed some further clarification. So, for example, um, the ideal target client is obviously affluent with a high end. The more expensive the house, the better, right? They have more to gain and more to lose, so they typically are maybe hesitating on selling because they don't want to pay the big capital gains. So this is a way for them to direct the gain. Again, it's not an exchange, but they're directing the gain into the opportunity zone investment, thereby eliminating the capital gains tax on the sale of their home. Now, you have to hold this for 10 years. And if you do, you eliminate the gains on the taxes on the gains. Is that right, Jim? From the
correct?
time you put it? Yep. Now, what's interesting, this is what stumped me, is you can actually withdraw money during that period. Like this is just the gains, the taxes on the gains that you're eliminating. If you're still running a business, if you still have a job, you're still going to probably be paying income taxes, things like that. You may have investments like Bitcoin or stocks and bonds and other things. You can actually withdraw funds out of this qualified opportunity zone investment to pay those taxes. So let's just let that settle down for a second and let that sink in, because that is a huge benefit. And I think, Jim, when you pull that money out to pay these other taxes, that's not a taxable event itself, right? There's no penalty for pulling that money out to pay those taxes. Is that right?
Well, there can be. I think what
Okay.
we're getting to, Gary, is we're getting a little bit into the territory where it needs to have some specific expertise from a CPA, but knowing that those things are an option is important because, as you said, it is a long-term investment, but it's intended
Hmm.
to be that way. I mean, it's intended to be. That's why the government created this vehicle, was so that investment in areas that needed it um, could be made, and the funds would remain there too.
Yeah. I mean, to me, it's an awesome opportunity. So, and we can always come back to this, guy, if there's more to show you. Like, in other words, how do you identify these people? And of course, on our team, we have an amazing tool called Really Flow. Um, it allows us to do just that. Um, so Jim, I'll keep an eye on the chat box. If you want to go ahead and continue, we
Great.
can always come back and flesh it out further.
Great. And yeah, I will talk to you, or I'll mention a little bit in a moment or two about how I've used ReliefLow and also how I've combined or kind of worked jointly with a realtor here in St. Louis, where I'm from, to do some marketing of the idea as well. So, and I'm happy to do that with anyone else in the team. So, let's see, on to slide 4. So this just gives you a little bit of idea where the eligible gain comes from. Again, in a primary residence, if a home seller is single, then there's a $250,000 exclusion for married couples, $500,000 exclusion. So, and I'll show you at the example here what that means, um, how that's applied rather. So again, a vacation or second home can be recognized capital gains may be eligible, or a rental property. So it can be a primary residence or a secondary residence. And again, stock, gold, bitcoins, those can all be deferred. So the example I'll just offer there is if you sell a home for 1.4 million, has a $600,000 basis, that means there's an $800,000 gain. The $600,000 basis can stay with the home seller. Of course, they can use that for downsizing or for paying off other debt or what have you, without triggering a taxable event. But of the $800,000 gain, married filing jointly has a $500,000 exclusion, and that leaves $300,000 that's eligible to be invested in an opportunity zone fund within 180 days of the sale. Yes, so that's how it works. And step by step, how do you go about doing it then? How might we make use of this? What I've done again with a local realtor here in St. Louis, and again I can do with anyone else too, is um, we did a mailer. We used Relay Flow to homeowners that met certain criteria. And you can look at the list any way you'd like. We happened to choose those who had been in a home over a certain period of time. They're ready to sell. You can search by loan to value. So the more appreciated, the better. I've used an AI tool that I developed actually as well to find the zip codes throughout the US where the price appreciation has been the most since 2008. So you can use a variety of ways to reach out to homeowners and offer to give them an opinion of value, estimate of basis, involve their CPA into the conversation, or you can just take this, of course, to your existing book of business for those who are actively selling or maybe those who are not. But the idea is to generate some conversation with a new topic. And the idea is to list and sell their home. And again, no one else is talking to clients about this. So it's a fresh idea. And if you like the idea of having a fresh idea of a fresh reason to pick up the phone and call people or to send them a mailer, then this is one of them. So again, we calendar the window up to 180 days so that from the time they sell, the funds have to go into the opportunity zone fund. And again, just the gains, not the entire gross proceeds, go in as equity. Um, Gary did correctly mention earlier too, this is not a 1031 exchange, but it does pair up with a 1031 as well. So if you have someone who's doing commercial business. Maybe they're selling a business, or maybe they have that has a commercial or a real estate aspect, or you have a client that is doing a 1031 for some piece of their commercial portfolio. Well, if they have any taxable boot, if you're familiar with that term, maybe they sold a property for 10 million and their replacement is only 8 million. Well, they have a choice they have a choice. They have to do something with that remaining two. An opportunity zone might be a perfect way that you can suggest to them that they can defer all the taxes on the last 2 million rather than going out and overpaying for a property or just paying the taxes on that last 2 million. So it can be paired with any 1031 exchange transaction as well. And again, joint marketing is something that I'm happy to do. You sell the home, I provide the investment advice. We can come up with common mailers, that sort of thing. Let's see. And then I would also say that, and some of this is a repeat, but I would also just say too, that there's always some drawbacks. And as Gary mentioned, it's a 10-year hold on the opportunity zone. So that is something that is important to mention. That makes it not for everyone. This isn't a one size fits all, but oftentimes for those who are maybe, say the 50 or 55 and older crowd that would be looking to downsize, generate some post-close income, do some efficient tax planning for they'll be leaving to their heirs, that sort of thing. It's a very good way of fitting right into that whole overall plan for them. Let's see. Were there any questions in the chat box? I'm not seeing it at the moment. Any questions so far?
Well, one question I have is, and this really goes back to the Genius Act being passed and the fact that, financial firms like Fidelity and some others are now you can invest in cryptocurrency through those traditional platforms. So in an earlier slide, I talked about um, being able to defer taxes on sale of some of those types of assets. So are there any specific rules? So let's say somebody bought a one Bitcoin in 2012 for whatever it cost back then, $100, and now it's worth $100,000. That'd be a pretty tremendous gain, But can they sell that and then direct the gain into a qualified opportunity zone investment, just like you would, just as if they sold a house? Is it the same process?
Yes. They have
Uh,
180 days from the sale to do that. They
Wow.
do. Mhm.
Okay. And it
And
is a little bit.
it's
Oh, go ahead. I'm
important
sorry.
it's important to know too that the OZ fund does provide the necessary paperwork for the tax preparer to make good on that. So and OZ funds can, one other thing I'd mention too is they can be invested in a number of different types. It's typically real estate, but not always.
Mhm.
One of the types of OZ funds that I personally favor actually does oil and gas drilling. And there is a lot of depreciation associated with that. Uh,
Mhm.
they have they have tax benefits associated with oil and gas drilling that is that provides tax-free income during the life of the investment. So I like the combination of deferring the taxes on the gains, tax-free income during the hold period, and then the appreciation during the hold period is tax-free as well. So some of the real estate backed opportunity zone funds will take a little bit of time before they generate cash flow, but they have very attractive overall risk profiles. So.
Okay. Um, well, Blessed she did type in a question there, and the question is, if I buy or if sell or buy, sell or finance. Hey, Blessed, if you want to unmute yourself, there might be a word or two missing. I just want to make sure I get this right.
When did the time clock start? The 10-year time clock?
Yeah,
When I'm
so
doing a
Mhm.
when I'm doing a monthly purchase.
Yeah, well, let's do one at a time. So let's do the seller financing. So Jim, if let's say Blessed sells her house, it's $1 million house, and she's married, so she have the 500,000 exclusion, which means 500,000 is technically eligible, but she sells it and owner finances the purchaser. So she's receiving her money over periodic payments over time. I don't know if that subject's
So
even come up.
I was thinking from my buyer's position, when does his time clock start?
Yeah.
Yeah, very good question. So installment sales are a bit of a gray area, and part of the reason for that is because they're negotiated, right? And so they don't fall in. The short answer is it might it might have the same effect, but the problem is the way that installment sales are written and the fact that they vary quite a bit um, causes my CPA to be reluctant to give strong advice that that is covered because the
Mhm.
IRS gives safe harbor. That's kind of the way they approve things. They'll give you safe harbor that if you do certain things, if you conduct a transaction, if you prepare your taxes in a certain way, if you take these certain steps, you're granted kind of a safe harbor that we won't come after you. And if you do things in a different way, it doesn't mean we will or won't go after you, but you don't really have the safe harbor of having gone down a well-worn path. And so the tax advice that I've been given is a caution flag to applying installment sales, even for a 1031 exchange. Now, other tax preparers may reach a different conclusion. So this is one of those where I'm not just giving you the standard, you know, talk to your CPA because I don't want to get in trouble. This is really one where I think that it matters because your CPA is the one that's going to put their name on your tax return. And
Mhm.
so this is a really important one. And so again, mine is kind of indicated that he doesn't want to put his name on a 1031 or an OZ for an installment sale.
Right. Well, the
Good.
reality is it's you look if you it's technically the difference would be is it a realized gain, so you know what I mean? So realized means they've
Mhm.
actually received the funds. So Blessed, I would definitely check with a tax accountant if you know one, or we can find you one. But
Could the 10 years start when the deed
I
goes
will
into
also add to
escrow?
that, and I don't want to get kind of, I'm
I'm
sorry.
sorry, getting off chart. Could when the deed goes into escrow, so if it's an agreement for deed, I mean, when you get the deed, could that be when the 10 years starts?
well, that's what we're saying, that if, even though a
Okay,
deed's being recorded, because
for the
the
equity, I'm
proceeds
talking about
for
the
your client, yeah, if
opportunity.
they're,
I'm thinking of the opportunity zone.
yeah,
Well, I think that from the OZ fund's perspective, when does the money come in the door? And I will say
realizing
this
it.
too. This kind of brings up another point. I didn't want to get too far in the weeds on this, but there's a little bit of a timeliness. There's a timely aspect to this, meaning OZs came about in 2017, and the idea was when they came up that there would be a period of time that, say, 5 years, that the original investment in the OZ would have 5 years to pay the taxes. That's the way they defer the taxes on the gains on the sale of property is they give you a period of time, and it was initially 5 years for the real estate in the OZ fund to either appreciate or refinance or have some other event which will allow the OZ fund to give back to the investor a dollar amount that pays their taxes. Okay, so like in this case, you're selling your home, you own a certain amount of taxes. The way the mechanism works is the OZ fund, you put the money.
Hi, I just want to take a moment to thank you for watching a recording of the Monday Night Live class. Hope you're getting a lot out of it. I'm sure you will. I wanted to let you know that, you can come to Monday Night Live whenever you want, but you can also participate more with the team. Why don't you set up a call with me, a one-on-one strategy call? I can go over everything with you, show you everything that we have to offer. For example, did you know that on our team, not only do you get your leads, we actually give you your own account on our lead gen system. So this puts you in control. You're not waiting on somebody to hand you leads. You get to pick the ones you want. Okay. Huge difference. We have 21 of our own proprietary marketing campaigns. They're all copyright protected. We're the only ones that can use them. Okay. The coaching is absolutely one-on-one. We got 3 coaches. We even have a 4th success coach that we have access to. Okay. One of left fewer than 100 in the world. Okay. One-on-one coaching. Right now the big problem is volume. We need more transactions. We need more inventory. I get it. Well, we know how to get it. Our team actually outproduces the national average by more than 2 to 1. So if you're struggling, don't do that anymore. If you're a solo agent, if you're a team, let's just talk. Smart entrepreneurs are always open to discussion. Learn what we have to offer, and then you can make an informed decision about staying where you are or moving on. You got to decide, if you're not where you want to be, you've got to take action to get where you want to be. Let's see how we can help you do that. I look forward to talking to you. Click on the link, set up a call. And by the way, I'll see you on the next Monday Night Live.
Money in, the property appreciates, or there's a cash out refi, and they give you the money to pay that tax bill. And I know I'm getting a little bit too detailed, but there's a reason for it. That the original structure for an OZ fund was that the end of 2026 was the end of the 5-year period.
So
Okay?
my question is so now you're saying it's 10 years. My question is, when does that 10-year time
I
clock
know,
start?
I know,
Okay.
and I'm
All right.
I'm taking a roundabout way, but I'll get there.
All right.
So,
I'll let you continue, carry on, I guess. Get
all
back to
right,
you.
yeah, thank you. So that 5-year period to pay the taxes on the original investment was to end in end of 2026. Well, with the big beautiful bill from this summer, that made it opportunity zones a permanent structure. So now it's not ending at the end of 2026, but the rules for the new opportunity zones are still yet to be determined. They came out with the law says, okay, this is now a permanent structure. It's not going to go away at the end of 2026, but the specific rules are yet to be worked out. So where that leaves us today is there are opportunity zones that are available now, probably through the end of the year, and that's the time for for investors to take advantage of this strategy is this fall is to take advantage now. It gives them incentive to do it now. They will be again available sometime in the middle of 2026 with a slightly different structure. But the answer to your general question is I think that the 10-year period probably is going to begin when the funds are invested in the opportunity zone.
Yep.
When they receive the funds, that starts the 10-year period.
So,
And
so
if,
Les,
and if I've
the
owned
thing is,
that, if I've owned that opportunity zone already for 30 years, that doesn't count, correct?
I'm sorry, say it again, please.
If I've owned that opportunity zone already for 30 years, that doesn't count, correct? My property's in an opportunity zone.
Oh, okay.
oh, she owned it
And
before
I've
it was
had it for 30
designated
years.
opportunity zone.
Correct.
Yeah, that's a good question. I tell you what, Jim, why don't we figure that out and get back to her because that's I hadn't thought about that one. You know, what if she already owned it before the designation came in? So, but back to what Jim was saying before. But so let's say you did an installment sale when a 10-year period starts counting. To me, it would make sense to start counting when you put the funds into the fund, into the opportunity zone fund. And it has to be from this, you'll see this in the world of lending. Like when you get a loan and you have to bring $25,000 to the closing table, they want to see those funds in the account that you're going to be using to pay for that 30 days in advance. So it's not like you can record the deed and you've still got 30 years of payments coming to you on your installment sale and take money from some other source and put them in the fund. That would probably not be allowed. Again, I'm not a Jim, neither Jim nor I are accountants or attorneys, but that kind of stuff is blocked all the time when it comes to legislation. They don't want people, you know, commingling funds from different things. They just don't want us to do that. So the point in all this was opportunity zone is to take the gain from the sale of your house and direct the gain into the opportunity zone investment. In order to do that, you have to have received your payments. So it's like you're going to be taking a payment every single month and directing it into the gain, right? That's technically your gain directly into the opportunity zone investment for however long your payout, your how forever long you're going to be receiving those payments. That's probably what a ruling would be. But again, I would definitely um, run it by your tax accountant. And a lot of them unfortunately don't know about these things. You've got to find the right person. But Jim, because of he has certain licensing that enables him to do this kind of stuff, probably has contacts. You know, between the two of us, we can bring somebody on and get you uh, definitive answers to those things within the framework of the all the legislation being complete.
I would think, Gary, sorry to interrupt you, but I would think that we could, I will. My plan is to ask those questions of one of the
Mhm.
opportunity zone sponsors. I mean, that's what they're
Yep.
there for. Is they, we at Great Point Capital, we identify which of the opportunity zone offerings in the OZ universe are appropriate or of interest to this particular client, and then that sponsor, that company that sponsors the OZ fund, they're expert at those sorts of questions. So I'm going to take the questions and go to one of them and
Mhm.
see what they will tell me about the installment sale and about the previously owned property too. Um, but they most likely have had all those kinds of questions asked. They
Mhm.
may defer. They may say, it's going to depend on your, but I suspect that they've had the question answered. And I also suspect that they're going to say, gee, again, with the IRS, if you're either in the safe harbor or you're not. If you're not, and if it's not really what the intention of the investment was for, doesn't mean you can't do it. It just means your risk of an audit is much higher. So
Um, no, I appreciate that, Jim, and listen, I definitely appreciate the question. The other part of it, her question, Jim, had to do with subject to sales, and that's something a lot of the folks on our team are familiar with. And what that really means is, well, here's what people do, just to give you the skinny on it. A buyer will approach a seller of a property and show them the benefits of putting their house in a trust. And then once the house is in a trust, because of the Garment-St. Germain Act, any lender that has a loan on that property can't call in the note. They can't do the due on sale clause when a house is put in a trust. It's just a little loophole in the law because what they're assuming is it's someone like me, like we're doing with our family home here. We're putting it in a trust, because it gives us benefits and protects the beneficiary's interest in the property. But what I'm getting at is um, they're actually selling the beneficial rights is one of the ways to do that, or they simply the the buyer who's going to take over the beneficial rights of the trust eventually does sell the property, either the rights, the beneficial rights, or the property itself. But the reality is there's no deed recording um, with that type of thing. The only deed recording is when you put a property in a trust, you're just recording the fact that the property was put into a trust, not a taxable event. There's no transfer tax, and the trust itself is not recorded either. So it really doesn't constitute a conventional sale. So, and yet there's money changing hands. So
Hmm.
that one, we definitely have to go to, you know, that would be a super advanced question, you know, because in that case, they are receiving some funds. The seller is, you know, so potentially it could be they could be not receiving any funds. They could just simply take over the payments, carte blanche, and just the seller just walks away from it. But um, in most cases, it's for a short period of time because the buyer is an investor, and they generally will look to convert that into a rental property or basically resell it. Or basically, it's almost like an assignment, but it's a subject to is its own unique, you know, way of investing. So I don't know if you've ever heard of that, but that's definitely a very unique scenario. So yeah. Okay. Um, hey guys, any other questions? You guys like this subject?
Yeah. Mhm.
Okay. How'd you like to talk more about identifying the right owners? You know, like how do you find the people that would be in a position to sell, $1.5, $2 million property, knowing that they've got equity greater than the exclusion, the $500,000 exclusion for married and 250 on single, and are probably sophisticated enough or at least curious enough to learn about this. So who'd like to find some of those people? I raised my hand twice because the reality is you get the commission. You're going to get the commission out of the listing. If you get the buyer, you get both sides. And Jim is going to help them actually direct the gains. It's a different function altogether. So he gets compensation there. But uh, so Jim, is it okay if we flesh that part out of it a little bit more? Like what criteria you're using in Really Flow? You talked about mailers, but what type of mailer, what's in the mailer, that type of detail.
Yeah, sure. I I've done two different mailers. One was a letter at your suggestion, which was hand addressed and stamped. And I also did a separate mailer where I worked together with a local agent to construct postcards. And I can show you what the postcard looked like too. But what we did was it depended a little bit on the zip code and the area we wanted to look at. So I didn't want to, and again, got some of your good advice on that too. I didn't want to send a mailer. I'll use St. Louis as an example where I am. I didn't want to send a mailer to 500 people. Uh,
Hmm.
I want to have it big enough that I can follow up with all of them, big enough that I can service them. So what we did was we ended up moving the price point around a bit. We looked for low loan to value, or we looked for homes that had been owned for quite a period of time. Uh, I also have access to another system. Again, the local agent did here. It would say, what's the age of the homeowner? Um, so anything that can give you Gary, help me out. What other criteria did we use in real e-flow? There was probably a couple other ones too. I'm kind of drawing
What?
a blank at the moment.
Yeah, it's okay. We were looking at the financing to see what their principal balance was if they had one, so we could pretty much determine their equity position. I mean, sometimes they own them outright, you know, which is even better because they got more, you know, more to gain or more at risk for tax purposes. But um, the area was really important. So guys, what you generally do is you want to draw a polygon around the areas that you know have, you know, the luxury home neighborhoods, generally country club areas, things like that. So it starts with that. It's all about demographics and social graphics. So we start with the area, and if you're not sure of the areas, you could do a search on properties greater than $1 million in value, right? And then on your map, see where they all are. And whenever you see clusters, draw a polygon around those clusters. Okay. So now you've got a geographical search going on that's based on home value, right? So once you're in there, then you can go in there and you can look for things like how long has the owner owned the home? So length of ownership would be important. And generally speaking, I like looking for people that own homes 25 years or more. There actually is a, a search term for that. It's called long-term owner. Okay. Um, if you do that one, and then you could also put in there, um, uh, you can look at the loan information, and you can say, okay, any person with a loan now less than, you know, 500,000, something like that. So you automatically have the spread, but 500,000 to 1 million. Um, and we can probably do this, Jim. If you want to log in, I could kind of walk you through and demonstrate this in front of the class using ReallyFlow and using the search criteria, and we can do a test on somebody else's neighborhood. And that's really how I like to do things, anyways, because I don't know all the neighborhoods in the entire country. I mean, I'm familiar with some of them from all the years of traveling and teaching, but we could, if somebody here wants to volunteer, we could
Yeah.
pick your area and help you, like right here on the spot, determine what the search criteria would be. And there's a number of opportunities for contacting those people. Jim mentioned a mailer. We do like our letters, but we have another letter that's not on ReallyFlow. It's a matter of fact, it's if you go into the team website, the, when you're a member of the team, you have another login to go in to the education. It's called EDU site. On the letter campaign, if you look closely, guys, you have the standard letter we use for most people. It's maybe 6 sentences. But if you look below that, it has a letter that says a letter to apartment owners. Now, what I'm going to suggest here is that letter is a little more formal looking. It does have a letterhead. It's more professional. And in there, we could reword that to address these people, talking specifically about qualified opportunities when investing and how they could take their gain from their sale of the personal home, direct it into through the investment, and avoid the taxes on their personal home, and on their investment, keep it for 10 years and avoid taxes on those gains. So we could get more specific in that letter that's more professional looking. It's just you just have to think through the audience that you're writing to. And my recommendation is always send that letter first if that's what you do, and then follow up with a phone call. Um, that particular client is gonna number one, they're gonna be more responsive because you're giving them more specifics in the letter. But number two is you sent them the letter first and then followed up with a phone call. In fact, in the letter say, unless you tell me otherwise or something like that, I would say, I'll be calling you when 7 days from the mailing of this letter. If you have any questions, it'd be a good time to ask them and tell them we could, help with them, talk to their tax accountant and so forth. So, in any case, sorry, I'm going down a rabbit hole here. But if Jim, if you want to, it looks like you already are sharing that screen. Okay. So go ahead and there you go.
Well, for some reason, it's not liking my password.
Can you click the I'm not a robot again after the password is in there?
Well, I think it's
That's okay. Hang on. What I'll do is let me.
maybe Maybe you should do this because for
That's,
some reason my password's not.
yeah, that's what I'm going to do. I'm going to go into mine. So hang on 1 second, guys. Let's see. Log in. Yeah, it looked like what was happening, Jim, is your password field was blanking out. It wasn't. It looked like it was loading, but it really wasn't. And then when you hit the enter, it just didn't recognize the password. So let's do this.
Can
Let
I
me
ask
share my
a
screen.
question?
Yep, go ahead.
Jim, question. So I just want to clarify. At the end, like for example, if I invested 300, right, from that example you had earlier into a fund, at the end of 10 years, I have to pay taxes on that 300,000, correct?
No, the way it's going to work is this. The 300 that goes into the OZ fund, there will be a mechanism, and I apologize. I really during an introduction, I hate to dive too much into the weeds, but this is an important one. There will be a mechanism that the OZ fund will provide. There will be a distribution from the fund to you as an investor in the amount of the taxes on that 300,000.
Oh, it's limited to the amount of taxes. So I cannot gain more than just the amount of that tax?
No, I'm just saying the 300 you put in, you will get a distribution to pay the taxes on that 300. So the 300 will stay in the fund, and over a 10-year period, that 300 may turn into a million, just for argument's sake. Well, there's no tax on the appreciation from 300 to a million either. So if you leave it in there for the 10 years, the appreciation while you're in the fund is not taxable, and the taxes on that 300 will have come to you as a distribution from the opportunity zone. There's always a mechanism that they have, whether it's refinancing the property and then making a distribution to investors, or there's a variety of different ways, but that's the most common one. They'll have they'll refinance the properties, give the investors a special distribution that will pay the taxes on the 300, right? Does that make
Is it
sense so far?
capital gain trust?
Capital gains, yes.
Tax, only that at
Mhm.
that time in 10 years. How big it will be then? Right now, for example, I would pay 15% or 10%, right? But in 10 years, it might be different.
Right. The distribution that they're going to give you, if someone invested today, the 300, and using that example, the 300 today, they will give us a distribution at the end of 2026. They will give us, let's just say, for example, on that $300,000, let's say that the capital gains was 50,000, okay? Just the taxes, right? So at the end of 2026, the Opportunity Zone Fund will be making a distribution to the investor in the amount of $50,000 for the purpose of paying the taxes on that $300,000 gain.
Okay. And the rest
That's
of
the
it,
mechanism by which your taxes coming in are,
okay, thank you.
yeah.
Tatiana, it's good to see you, by the way. Hopefully everything is going well for you up in
Yeah, thank you.
beautiful Worcester.
This is my first time here at
Yeah.
this meeting.
Yeah. Yeah, if you wouldn't mind, guys, say hi to Tatiana. She and I have been talking for a couple of months now about investing and brokerage and all that. And I knew her years ago because I taught up there. And some of you might remember uh, Justin Jarbo. He was a mastermind colleague of mine too. He's from the same exact office. And in any case, good group of people and a good place to invest. Yeah. So about an hour outside of Boston. So
I don't
in
see
any
a way
case,
to put my picture there, so I guess because I'm not signed up for a workplace.
that's okay. You can turn on your camera anytime you want. Sometimes people this time of night don't want to turn the cameras on, and that's okay. So,
Okay, next
hey
time.
guys, I'm going to share with you my screen, okay? And This is real eFlow. So those of you who are not familiar with this is a tool I bought for the team several years ago to allow us to search for people and properties, residential properties anywhere in the country. Okay, it doesn't matter. There's no exceptions. I'm going to go to property leads, and I'm going to choose an area I'm familiar with called Fox Chapel. This is where I used to live when I was living up in Pittsburgh area before. So a great area, great school district, right on the river, Oakmont, where the famous um, golf tournament, Oakmont tournaments held there every year. Great, fun thing to do. So in any case, I'm going to go ahead and hit the enter key. Actually, it looks like it's already got a search going to see, or hang on, let me try that again. I don't think I have any criteria set up. In order to begin your search, we did that. Nothing to see, or we couldn't find any result. Well, that's crazy because Fox Chapel's full of homes. Let me start that from scratch.
Is it your filters, Gary?
Well, there's only one filter. I've seen this happen before. It's like the software just gets tired or something. It's weird, but okay, here we go. Let's see what happens now. All right. Fox Chapel, PA. I really like that. You know what I'll do? I'm going to do the county actually. I should have just done that at the beginning because I always like starting at the county level. Allegheny County, PA. Okay, so 447,106 properties. Now I wonder if I put in Fox Chapel now. Let's see if that doesn't mess it up. Yeah, so there's one there for 3 million.
Gary, one thing I want to point out one thing that I learned through the process was if you use the polygon,
Yeah.
you can't save the search.
Oh, that's right. I remember that.
You can save a search for zip code or for counties or what have you, but for the polygon, it doesn't allow you to do that, just small.
Yeah. Okay. What I'll do is I'm going to focus on single family homes only. No townhomes because Fox Chapel, vast majority of it is there's some beautiful homes there. It's amazing. So let's start with this in the criteria. Let's start with long-term owner. And if you hover over the question mark, it tells you that's people who've owned a home 25 years or more. Okay. Now I might miss some opportunities this way, but I know generally speaking, when I narrow it down like that, I'm going to more likely get people who have their mortgages paid off or paid down dramatically. Okay. All right, so we're going to start there. Now I'm going to scroll down into more criteria. I'm not going to use the marketplace data there. Not going to use the searchability scores. So property valuations, I'm going to put minimum 1 million. Okay. So now I've got long-term owner, 1 million or more in value, and there's single family homes. And if you look down at the bottom, it says see results 671. Okay. So let's do this. Let's also go back up here and let's click on free and clear. Okay. That means they have no mortgage. And that takes us down to 365 properties. Okay. So what I'm doing is I'm using the criteria, search terms, to be very selective and strategic. I'm trying to think of search terms that work well together. So if you think about it, somebody that's owned a home 25 years or more, okay, they own it free and clear. Would you agree they might be more open to something like this? They're at that point in life, they may be in their 60s, kids are grown and gone, they've got this beautiful home, and they maybe want to move to Florida, but they're looking at this huge gain, tax on the gain over and above $500,000, right? So that's the kind of person we want. Now we can try to even get more specific. Like I could have said, instead of free and clear, I could have just selected high equity, people with a lot of equity. So let's hover over that question mark. So in order to have high equity, that means, well, I'll just read it to you. The equity-based lead, these properties are owned with a mortgage on the property and the loan to value is less than 60%. That means they owe 40% of the value of the property and they owe 60%. So quite frankly, I'd rather have free and clear. Well, let's just scroll down and see what else we can find here that might make sense to include. So we already know the houses are over $1 million. It really doesn't matter so much about bedrooms and pools and things like that because most of those places are going to be nice homes. All right. How about ownership information? So what we can do here is, let's see, we can select owner occupied only. Okay. I mean, we could try out-of-state absentee owner, but that's not very likely in this neighborhood because I know the neighborhood. Usually people that own those homes actually live there. Well, what I can do is only choose individual owners. I could eliminate business-owned properties. That would be properties owned in like an LLC, properties owned by banks, properties owned by the government. Trust could work, but remember earlier in our discussion, we talked about properties inside a trust. In fact, let me go ahead and select. I'm going to select that and individual. So I'm going to look for individually owned properties and properties owned in trust, and that took us down to 353 properties. All right. Now let's look at what else we have here. Debt to equity. So we did say free and clear, so know the equity is 100%. Okay. We don't want a property that's listed, so we could. Well, let's leave that off for now. The previous sale information. We could say something like, see, then we got free and clear. I was going to say we could put in here last sale price 500,000 or less. That means they automatically have 500,000 in equity or more. But let's leave that off. And they're probably not going to be in foreclosure. Okay.
Those are I like the way you're thinking about it, Gary, but I would also then add you have to factor in if they're married, they get a 500,000 exclusion. So it might
Right.
cause you to bump up, like for example, the sale price
Yeah.
to a higher number, just because if they do have, and you have low loan to value, for example, they might have 40% debt, but with the 500,000 exclusion, it might make the taxable gain a little bit less. So that's the sort of thing. And I'm not picking on your numbers, but I'm just offering that as a suggestion. Anyone who's listening and saying, well, that's how you can manage the number of results you get at the bottom. See, we went from
Well, that was perfect, Jim, because look what it did. It took us down to 56 properties. So everybody, this is really important. I had this discussion with one of the students the other week, and I emphasize how important it is to start small, like you want to learn small. So 56 people is easy for any of us to communicate with a custom letter or follow up with a phone call, because you want to test this out. Remember, you're doing something new. This is a new marketing campaign for you. So you want to make sure you have your script down tight. You understand your prospects, um, and really you're trying to maximize the probability that they're going to be interested, right? And minimize the possibility that they're not interested. So 1.5 million, you know, and we know the only is free and clear because we selected free and clear. I could have selected high equity, like Jim was saying. So let's go ahead and do that. Let's deselect free and clear and select high equity. And that's taken us down to 44 properties. That's even better. So what we would do, guys, is we would download this file of all the contacts, get all the information, and I'll just show you the information you get so you see why this is so important. Let's look at this one here. By the way, always ignore the ones in blue Those are properties that other agents or other investors are wholesaling or signing. We don't really care about those. We want like this one here on Waldheim. Okay. In fact, I think I actually might know these folks, but in any case, beautiful home. Look at that. Actually, I do know these folks. I've been in a house before. So in any case, now that was actually listed. We could target them, but remember, if it's already listed, you're not going to get the listing. Okay. You can get the buy side and this will still work. But you get all of the lead flow valuations, the retail value, the wholesale value. You get the lead types. It's an active listing. They paid cash. They have high equity and they're a long-term owner. And Frank Robinson, some of you might recognize that name. In any case, you get all this information on the property, right? And if you scroll down, you also get the financial information, the loan information, right? Who made the loan? Dollar Savings Bank is a big bank in Pittsburgh. They got 3.2% in 2020. They had a variable line of credit in 2013 with 3.6. So they got the low 3.2 interest rate loan and paid off the line of credit, obviously. And when they bought it new, that was in 2009, at the bottom of the recession. So they got a steal. They bought that thing for 417,000 in 2009. See, this is what wealthy people do. They wait for the opportunity, and that's when they buy. 2009, prices were plummeting. Remember, this house is valued. Let me go back there. Well, retail here says 1,619,000, but it's being listed for sale at 2.36 million. So how'd you like to buy a house and 15 years later where the price has gone up more than 5 times? So in any case, yep, I'm pretty sure Frank Robinson is savvy and sophisticated and will be interested in learning about this opportunity we've been discussing. So let me do a quick pause here, guys. So I'm going to stop the share because we're now 5 after 8. I want to be respectful of Jim's time. So raise your hand if this is starting to make sense, what we're talking about tonight. It's an excellent marketing idea. I mean, if you're looking for a listing and you want to make a nice, big, juicy commission, this is the kind of stuff that we suggest you do. These folks have needs. I mean, I know people personally that are very wealthy, but they had never learned these types of things. So you don't have to be the expert. Remember, you've got Jim here. So all you have to do is do the marketing, do it jointly with Jim, I suggest. Bring him in, let Jim explain the opportunity to them. You get the listing, right? And Jim gets his compensation. And it's win-win for everybody. You have a client that now is going to go to the country club on Saturday to go golfing, and they're going to tell him his or her golf buddies and tennis partners what they just did. They're going to ask, well, how did you do that? Oh, you've got to call Jackie. You've got to call Kathy. You've got to call Grace. And they're the one that helped me connect with Jim and be able to avoid paying all these taxes legally. And I'm making money on the investment. That's the kind of conversation you want to have. Sound good? So, okay. Any questions? Any comments? I mean, and is Bless still on? Looks like she's right. Oh, Bless, Bless, thanks for bringing it up, Bless. And I'm glad you brought that up because I hadn't thought about the subject too. It just never crossed my mind. But subject twos happen at all levels of the market. It's not just people at the middle range. I mean, if someone can engage in a transaction that gives them a tax break or delays the tax burden, most savvy people at this level are going to listen, So, okay, I'm going to shut up and let you guys talk or ask questions. Or at a minimum, give him a big thanks.
Thanks, Jim.
So,
How about agreement for deed?
agreement for deed. Jim, did you hear that one?
Does that change anything?
You know what, I'm going to have to put that in the same category with installment sales and the 30-year owned.
It's
They're good
similar.
questions.
We'd be similar to a subject to the question. I think what it's going to come down to is when is the money moving into the qualified opportunity zone investment? I think that's going to be the final litmus test. I mean, but let's run it up the flagpole and get the definitive answer from,
Yeah.
um, you know, a qualified tax accountant or attorney to make sure. And guys, we can report back on this next week. So next week, when Kyle comes on, we'll take a few minutes in the beginning and get back to this subject. Okay.
Yeah.
So Kathleen for
And
all. Thanks,
you know,
Kathleen.
I know these things take some runway. I mean, it
Mhm.
takes a little time to kind of get one's head around it. I try to keep it pretty basic. I got in the weeds on a couple of things here, but I'm happy to talk to you about it. I know it takes a little bit of runway, it takes a little bit of time to get your hands around it, but there is a bit of a timely item here that the OZ funds that are available now will probably wrap up, and they have a fixed size. They'll probably wrap up this fall. There will be more OZ funds maybe next summer or more late fall as those rules come out. But this is something that you could use to create a little bit of a sense of urgency too. This is a tax vehicle that's available now, and it will be in the future, but there's going to be a gap. So if you're thinking about doing it, now's the time.
Okay. Um, Thanks, Jim. Hey guys, a couple quick things here. We do have some new folks on. Camille is right in the smack in the process of joining. Okay, I think she just joined. Kathy McDevitt is looking at the opportunity now, looking at the team and EXP and doing her exploration and due diligence. And Kevin Kelleher's been also at the same category, and Tatiana too. So thanks you guys by the way, so when I say guys, I generally mean like everybody. So
That's
thanks
okay.
for joining us tonight, Kathy and
You.
Tatiana and Camille. So I appreciate that, Okay. Well, listen, guys, if you don't have any questions, I'm happy to log off. I got two of my
Actually,
sisters here.
I've got one question.
Okay, thanks, Tatiana. Go ahead.
So, as my understanding is, you have to qualify for this, you have to invest into the qualified fund. You cannot just buy property in opportunity zone, right? So if you just buy
Correct.
property, it doesn't.
Yeah, that's a true statement, Tatiana. Yes.
Yes.
I mean, you can still invest in opportunity zones
Yeah.
just right out of the gate on your own. Yeah. Yeah.
And they're not all, it's not, they're all, the properties in opportunity zone funds are not blighted properties necessarily at all. I mean, I'll give you an example. Downtown San Jose, California, which is just downstream from San Francisco and Silicon Valley. Downtown San Jose is a huge opportunity zone. So it's not the sort of thing where investors are putting their money into something that is very sketchy or has a low probability necessarily of doing what the sponsor's hoping. So they're very strong properties led by very strong companies that have good reason to that have done this before, and they have good reason to promise. Well, they don't promise, but to project some really attractive returns.
And those funds approved by IRS and by Security Commission and
Yes, by FINRA is the regulator that oversees broker-dealer activity, and opportunity zones are similar to DSTs and other types of securities that have to be sold through the broker-dealer network, like Great Point Capital. And Great Point Capital is very regulated by FINRA. So yes, FINRA is the one that makes sure broker-dealers are selling only products that are approved by FINRA and that are in compliance with IRS, guidelines.
and they have history, right? You can show their profits, how they were profitable in the past few years, right?
Yes. Oh, the fund sponsors will no doubt have the ability to demonstrate what their past histories, about their past successes have been. And it's a very common question is to ask is to say, well, what have your results been in the past? When has it not worked out so well? And any experienced operator has winners and they have some that didn't turn out as well. And so those are all very fair questions to ask and expect good answers for as a part of the due diligence process. So when someone gets interested, it just starts a conversation where we can explain things. And then the next step is to get the client and their advisors, whoever their inner circle might be, whether it's a CPA or tax attorney, get them on the phone with the sponsor of the Opportunity Zone and get all their questions answered before they have to make a decision. So they're not
Okay.
having to guess.
Sounds good.
Yeah.
Thank
Okay.
you, Jim.
You're welcome.
Yeah, thanks, Jim. This is good stuff. I love the subject, and I think it's an excellent opportunity. So, guys, set up your one-on-ones if you haven't set up a one-on-one for a while, and let's you know let's exercise the legs on this thing. If you know the old saying, um, the only way to receive a guaranteed no answer is to not even try. So, so my suggestion is put forth your best effort, give it a shot. I mean, good Lord, that's how stuff comes your way. It's you don't know how and why sometimes it could come out of left field, but it's just the way it works. You've got to get in the game and swing the bat. So, and anybody can send out 44 letters and make 44 phone calls. Get those conversations going and make yourself a hero. That's what this is all about. So, okay. Well, listen, guys, I hope you have a wonderful rest of the night. And this is the week for those of you who are on the team. This Wednesday is our monthly team call. So this is going to be on the 10th, 7 p.m. Eastern. And you guys already know how to log into that. I'll see you then. I'll see you on the one-on-ones. And in the meantime, take care of yourselves. God bless you and all your loved ones. And have a great night.
Good
Thank
night,
you.
Thanks
Gary.
again, Jim.
Thank you. Good night.
Thanks, Jim.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.